There's one type of dividend stock out there in the stock market that pays the most insane yields that you will see. I'm talking 10, 11, 12, 13, and I've even seen more than that on these stocks. It's super insane. The percent yields are ridiculous. We're going to talk about all the risks, all the rewards, whether or not you should consider adding some of these stocks to your portfolio, and then a few special scenarios. And then I'm going to give my top pick for a company you can buy that has an insanely high dividend that is in this asset class. But first, before we get into all that, I'm Austin. If you're new here, I'm a co-owner of cloudmusictweet.com. I'm a stock market investor, and I do actually hold shares of these types of companies, and I'll explain which ones later in this video. If you're new here, thank you for being here. If you've been here and you're a subscriber already, I appreciate you greatly. We're somewhere around 400 subscribers. I don't know where we'll be at by the time we post this video, but I appreciate you greatly, and as a thank you for hitting that subscribe button, here's a picture of both my cats who are off camera over there, Millie and Luna. Millie's the gray one, Luna is the brown one, okay? All right, let's get into this video here. This type of stock that you might see out there in the market is probably not what you think. I bet when you clicked on this video, you thought that I was gonna talk about REITs, which are called real estate investment trusts. Real estate investment trusts typically have extremely high yields, high dividend yields, because to be classified as a REIT, you have to adhere to a specific payout ratio as it relates to your total earnings. But this other type of company also has some tax implications around it where they have to pay out a substantial amount of their revenue as dividends, or actually they're called distributions. So this stock type is called a master limited partnership, or sometimes you'll just hear it as limited partnership, and sometimes you hear it as the abbreviation MLP. These stocks are very attractive to someone who's looking for a dividend stock, someone who's looking for a little bit of yield so they can get some cash flow into their accounts. What you can do with dividend money is you can take that dividend money and reinvest it back into more dividend paying companies to grow the payout bigger and bigger and bigger each month or each quarter or each year. Or you can take that money and go ahead and flood it into other stocks, maybe like growth stocks, and you just have money coming into your account on a regular basis. Or if you're closer to the retirement phase of life, you can use this for some extra income. You can take that money out of your brokerage account every single time they pay you, put it into your bank account, and use it to fund your lifestyle. I think that is the last way you should use dividend money, and it should only be very much earned, right? So you should have been able to build up a massive amount of money so that you can live off that cash flow. If you're not in a position to live off your portfolio and you still need to work a job, don't be taking your dividend money out of your account. Okay, let's talk about MLPs and the specific risks and rewards that we can see with MLP stocks. So the first risk is a very obvious one. A really high dividend yield company is typically seen as a little bit riskier than a blue chip stock that might be paying like 2 or 3 or 4% yield. So most of these companies, people see them as kind of like a yield trap. Maybe you see the big 10% yield, and that's the first thing you see. It's almost like a sales sticker, you know? You see the sales sticker, it gets you excited, it gets your mental ready to do something, ready to take some action, right? But when you look a little deeper, sometimes these companies are in some financial trouble, and maybe the dividend is gonna be suspended, maybe the dividend is gonna get cut a little bit, or maybe they're just never gonna be able to raise that dividend because maybe it's a dying company, or it's a bad management team, just straight up, or they're paying so much out because they have to on a federal basis to stay as an MLP that they're not able to take those profits and invest them back into the business. So that would be the main risk as it relates to MLPs. Slight like weird situation, not really a risk, but something that kind of turns people off is there's a different type of tax form that you have to do when you own an MLP stock. So around tax time, if you own any units, they're called partnership units. With a stock, you hold shares. With an MLP, you hold partnership units. So if you hold units in any of these companies, you're gonna get something called a Schedule K1 form. They're gonna send this directly to you in the mail in paper copy. I've always gotten mine as a paper copy. It's actually really easy to just go ahead and report these as other income, Schedule K1 on like TurboTax or whatever tax software you use. It's actually super easy, but it is a little bit more work than just putting your 1099 consolidated in from your brokerage account like you would for regular dividends. So that kind of turns some people away. If you're okay with that extra tax work, that's fine. If you're not okay with that extra tax work, but you still want exposure to MLPs, I'll talk about an alternative to this here in just a little bit. The rewards with owning an MLP are sometimes the tax situation. Since it's a Schedule K1, you can sometimes actually take a loss on your investment in that year due to something called a return of capital. I'm not going to get into all the tax situations, but that's one tiny little benefit benefit. And then obviously the very clear benefit is the really high dividend yield that a lot of these companies pay. And some of these companies, if you choose the right ones, that dividend is going to grow over time and you're going to get rewarded continually as time goes on. So let's talk about some specific companies and the specific dividend yield that they're going to pay out right now. So Energy Transfer is one. The ticker on this is ET. You'll find it as Energy Transfer LP. That LP stands for Limited Partnership. This is a $40 billion market cap. And right now, the dividend yield is so close to 10%, 9.76% dividend yield on this. That is super massive when you consider that the S&P 500 on average goes up about 8 to 10% a year. If you're just getting a 10% yield, you can see how that's really attractive for a company like Energy Transfer right there. It kind of pulls shareholders in, and that's what hooks them and keeps them in the stock for years and years and years. That's Energy Transfer's goal. Another one is Enterprise Products Partners LP. This is EPD, ticker on the market. They're paying a 7.55% dividend. Next one is Westlake Chemical Partners LP. Ticker is WLKP. They're paying 8.67%. Next one up, what's the lowest yield on the list actually? Brookfield Renewable Partners LP. This is BEP on the market, 4.58% yield. Alliance Bernstein Holding LP. This is ticker AB on the market, 8.61%. And then the last one, Alliance Resource Partners LP. This is ARLP on the market, 15.67%. That is wild. So as you can see, some of these companies have insane dividends. We went somewhere between a 5% and a 15% dividend yield. That is massive. You're not going to find that type of dividend outside of anything other than like a REIT or something like that. But you're going to get a lot better tax treatment with a limited partnership as opposed to a REIT, which is always counted as ordinary income. With the LP, you can sometimes get that return of capital like I was talking about, and your distributions can be qualified or ordinary. Once again, this is not a tax video, so I'm not going to get into the implications around it. Just make sure you do your own tax research before buying an investment vehicle like this. A lot of these companies are in the oil and gas industry. I'm not a huge fan of the oil and gas industry. I understand there's an insane amount of money to be made in oil and gas is not going anywhere over the next decade. Yes, it's going to decrease in terms of total market share as we look at automotives, as EVs kind of take more and more market share. But look, oil and gas is not going anywhere anytime soon. So I understand that there's still a lot of money to be made. It's just not where I like to invest personally. So we talked about Energy Transfer, that was ET, Enterprise Product Partners, EPD. Those both are two companies that people love to look at as it relates to LPs. That's what they would think of when they think of MLP most of the time, is those two companies. Both of them are in the oil and gas industry, and specifically if we look at the balance sheet of Energy Transfer, there's a lot of risk here. Although they're trading at less than a 0.5 on a price to sales metric and 1.2 on a price to book metric, when we take a quick look at the balance sheet, we will very quickly see that the total liabilities this company has on the books is actually greater than the market cap. The total liabilities for this company is $64 billion, while the entire market cap is only $40 billion. And the reason this is what it is because a lot of these LPs are what we call midstream pipeline companies. They're trying to move your oil and gas products from one place to another place. So they have to have a ton of PPE, plant, property, and equipment. They're an asset-heavy company. How do you buy a ton of assets? If you're a company, it doesn't make sense to just buy them with cash. To even get the amount of cash they would need just isn't feasible in order to buy these things. So they buy them on loan and then they pay that back over time. That's why the liabilities line ends up being so high. I personally am not super comfortable with an extremely asset-heavy company that has to have a ton of debt on the books. An asset-heavy company that has not that much debt on the books, that's a good situation. If this wasn't an income vehicle, I would feel a little bit better about it. But they have to take so much of their cash and pay it out to shareholders to sustain that 10% dividend yield that it just risks the situation a little bit too much for a lot of investors. So that's why I'm going to talk about a slightly different sector, still an LP, that I think is a much better place to invest. I think the best place to invest in an MLP is actually in the financial sector. And the company specifically that I think would be a great one to look into if you're looking for an MLP to add to your portfolio for a massive dividend yield, is AllianceBernstein Holding, and that is ticker AB. So there's something really interesting about this company that might, on first thought, seem like a very bad thing and a negative thing, and it's that their dividend is actually variable. So they're not committed to paying the same dividend quarter in and quarter out and slowly raising it year after year after year, like a stock like Coca-Cola would do, or Pepsi would do, or Waste Management would do. That's not what they're trying to do. Instead, they pay out 100% of adjusted earnings to shareholders. So whenever they report earnings and they say, here are adjusted earnings, that's also the exact same as the next dividend yield that they have. So in the last quarter that they reported that ended on March 30th, they had 66 cents of EPS. Every share that you own or every partnership unit that you own, you're gonna get 66 cents paid out to you in the form of a distribution. And when we look at the last few quarters, 71 cents, 64 cents, 70 cents, and then of course like the 66, like I just talked about, that's what you get paid out as a shareholder. So what happens, since this is an asset manager, is that when the stock market's doing really well, you're gonna get some insane distributions, some insane dividends. I've gotten the highest dollar amount distributions from AllianceBernstein that I've ever received in my entire life. And this was specifically when the market was roaring higher, because remember, an asset manager typically works on a percentage fee base. So if the percentage fee base, they're working on a larger pot of money because they're handling more assets, because assets are moving up, then you're going to get more of that fee base because you get 100% of the adjusted earnings from AllianceBernstein as they pay that out to shareholders each and every quarter. AllianceBernstein trades very respectably in the PE ratio category and the price to book category, okay? So the trailing PE on this company is around 13 and the forward PE is around 11. We love to see a forward PE lower than the trailing PE, which means earnings are most likely going to expand over the next few quarters. On a price to book metric, they're at a 1.7-ish. When we compare that to someone else that's an asset manager like JP Morgan, that are really not trading that much more rich on a price to book ratio for somewhere around a 4x of the dividend. I believe AllianceBernstein not only has an amazing dividend right now, but that dividend is going to grow in the future. And I think this is an undervalued asset that can be picked up for very cheap. You can buy some partnership units that are going to pay you a great dividend. Just remember, you're going to have a slight more amount of tax work with that K1 form, and you're going to get a variable dividend. The dividend changes on a quarterly basis because they're paying out 100% of their adjusted earnings out to shareholders. Ever since the 2008 financial crisis, this stock has been a very different company than it was before the 2008 financial crisis. So if you bought at the lows in 2009, you would only be up 2x. There are companies that you could have bought at the lows in 2008, 2009, where you'd be up 10, 20, 30x your money. So it's important to understand this is not a hyper growth company. They don't have enough money to keep in order to invest back into the business on a consistent basis for you to get a 3, 4, 5, 6x return like you would with something like Tesla or Palantir or SoFi, like a growth company. Understand that this is an income vehicle. If you're not ready to buy an income-driven vehicle, maybe don't consider AllianceBernstein. Go for something like a growth stock. But if you're looking for that juicy yield and a ton of cash that you can go ahead and invest back into more dividend stocks, or you can take this money that AllianceBernstein's paying you and invest it into growth stocks, then this could be a company that you can consider adding to your portfolio. If you want exposure to MLPs, but you don't want to worry about the extra tax situation with the Schedule K1 form, what you can do is you can buy an index of MLPs. And a good one would be the Alarian MLP, ticker is AMLP. One, this has a rather high expense ratio. That's something to check out. And two, when you look at the total return of AMLP, they're down 50% over a 13-year span. So investing in all MLPs might not be the greatest idea. You really have to find a diamond in the rough as it relates to LPs, in my opinion. Once again, if you're not worried about that and you're okay with kind of a stable stock price and a massive dividend, that's okay. You can use that money to go ahead and buy more stocks. But AMLP has not had a good time since its inception 13 years ago. Yes, it's paying an 8% yield on a yearly basis, but if you're losing 8% in terms of the share price and you're getting 8% back in terms of dividends, you're net nothing, right? So that's not a good situation. So you really got to be super picky around which stock you pick that happens to fall in the MLP category. I want to know if you're buying any of these super high yield stocks out there. Which ones are you staying away from because you think they're yield traps? Do you think they're all yield traps, or do you think there's some diamonds in the rough? What are you buying out there? I want to know if you own any of these partnership units of any of these MLPs. Okay, let us know in the comments. I want to hear about it. Thank you for stopping by and have a great day.